Let's talk about different hedge fund strategies. The most common one is called long short. And long short hedge funds have different exposure limits. And I'll give you an example. You're a hedge fund. You have $100. 75 bucks or 75% of your capital is long stocks, meaning you own stocks. And the other 25% is short stocks, meaning you're betting against stocks. And so your net exposure is basically going to be longs minus shorts, or 75% minus 25%, for a net exposure of 50%. Okay, that's your exposure. Now, there are some hedge funds called market neutral hedge funds, and I worked in this industry for these types of companies. And that means that you never have too much exposure to the market, long or short, okay? And so quite often market neutral strategies have 15% maximum long or short. And they're focused on capital preservation in case the market goes down a lot, okay? Now, the danger of market neutral is because you're perfectly balanced, you can lever up if you want to, meaning for every dollar in capital you have, you can literally have $5 invested, right? And if you're right a little bit, you make a lot of money. If you're wrong a little bit, you're out of business. Very, very dangerous. Very dangerous. Leverage is a bad thing. Then there's something called event-driven. Event-driven analysts are basically analysts that look at companies that just got acquired, right? And let me create a hypothetical example. So let's assume Coca-Cola just bought Red Bull for $50, right? You'd think the stock would go up to 50 immediately, right? It doesn't. It usually goes to 49 bucks or close to 50, but a little bit less. And the reason it's a little bit less is because there are some investors that believe that this transaction is not going to be approved by the regulatory authorities, right? And so a lot of event-driven firms are run by lawyers, right? They understand the legal code well and antitrust well. And what they'll do in these event-driven funds is they will have massive short positions on the acquirer and massive long positions on the acquiree. So in our fictional case study with Coke and Red Bull, they would be short a massive amount of Coke and long a massive amount of Red Bull if they thought that antitrust would approve the deal. And so let's say they invested in Red Bull at 49 bucks, a huge amount, right? The spread between 49 bucks and 50 bucks, right, is where they make their money. And once antitrust approves it or the deal is done, then what happens is that spread closes and event-driven investors make money. The opposite is an absolute catastrophe. There's also activist investors like Carl Icahn. And investors that are activists will basically buy big positions in companies without telling anybody. And then they eventually have to file like every quarter to tell the market how much they own. And then they'll say, oh, here we are. We own 20% of your company now, and we want a board seat, and we want to fire the CEO, or we want to break up the company, or we want eBay to spin off PayPal, which is what happened, okay? They're activist investors. Next up, you have macro hedge funds. And my old boss at a big firm I worked for called Citadel, he used to work for George Soros back in the 90s. And Soros made a fortune breaking the British pound and the Thai baht as well, right? And so Soros isn't really an equity investor per se. He'll play big macro bets. And so he forced the British government to stop having their currency pegged to other currencies. He made them float it. It's kind of complex how he did it, but he made a lot of money. I think it was about $1 billion in one day. And so the last one is artificial intelligence or computer-based trading. You recognize that music? What's that from? Sorry, I'm having too much fun with this. So AI or computer-based trading is going to be much more prevalent and successful and popular in the future, obviously. And there's one incredible hedge fund called Renaissance Technologies. And Renaissance has thousands of computer servers running in parallel that pick stocks based on insider sells or buying, meaning management team buying or selling stocks, and many other factors, right? And so given the lower cost of computing and incredibly cheap but effective internet cloud systems or platforms like Amazon Web Services, where prices are dropping a lot, I expect artificial intelligence or computer-based trading systems or hedge funds to be very popular in the future.